Do you know when to push the sell button? Well, without a crystal ball or a DeLorean, it's kind of anyone's guess. There's a lot of indicators we can use, though, and maybe even some historical patterns that may not exactly repeat, but could certainly rhyme. And history might be whispering of those rhymes and clues again. So stick around as we try to narrow down the window using some of the most compelling and some of the most controversial theories that are circulating in the cryptocurrency market right now. And of course, one of them might just land closer to the truth than we think. The most popular theory, of course, is the Bitcoin 4-year cycle theory. The Bitcoin halving happens every 4 years. It slashes Bitcoin's issuance rate, reducing, of course, the flow of new coins into the market. Historically, this has been a very powerful spark for bull runs. Supply available goes down, demand keeps going up, prices go up, money flows down. Bitcoin's peak has typically occurred more than 500 days after a halving. The only exception was in 2013, following the very first Bitcoin halving, when the peak came at just over 360 days later. Now, as of today, and it's a small data set, mind you, but now as of today, we're around like day 466, 467, depending on when we post this video, and likely further along by the time you're watching this. That puts day 500 in the first week of September and day 550 in the final week of October 2025. Now, if we consider the pattern from previous cycles, especially the trend of wrecked September followed by a stronger October price action movement, then a late October peak becomes a relatively compelling scenario if the Bitcoin 4-year cycle does indeed continue and works like clockwork this time, then that's when we should expect a peak to come in. Another way to measure is by counting weeks between cycle peaks. The first to second peak took 208 weeks, the second to third about 203 weeks. Applying that same 203-week rhythm from the 2021 top brings us once again into late October. Maybe we extend that sometime in November for the higher number there. But not everyone buys into the 4-year cycle theory anymore. And of course, it remains to be proven if it will actually act again as the guiding signal for the markets. Some say it's dead. It's a theory I think has weight, that Bitcoin's behavior has simply changed now that Wall Street is here. That crypto no longer runs on this 4-year cycle, rather it runs with the stock market. And it does make sense. The US Bitcoin ETFs alone control more than 6.16% of the 21 million BTC supply. Treasury companies are controlling another huge percentage of it. And it's not all Bitcoin either. Ether ETFs have now recorded 16 straight days of net inflows, pulling in $453 million this last Friday. Aside from ETFs, companies with deep pockets doing the treasury company thing, they're buying truckloads of coins. You have Sailor's MicroStrategy, which is always long on Bitcoin, buying gargantuan sums. It's bought another 21,000 this week. There's Japan's Metaplanet aiming for 1% of the supply, and on and on and on and on and on and on. The numbers keep growing every day. It seems that not a day goes by and we don't have some kind of new treasury company announced. We have Solana being accumulated by publicly listed companies like Upexi and Soul Strategies, and they're doing BNB, and they're doing XRP, and they're doing Dogecoin, they're doing SUI, and it's crazy, man. Tom Lee and Joe Lubin fighting out to see who can buy more Ethereum right now. And I'm here for it. Pump my bags, guys. This is a stark contrast to previous cycles where institutions and governments were very much against crypto. So people are going to say this time is different, is dangerous, but this time is not different. We're actually in the institutional adoption phase of the asset class. We're in the ETF phase of the asset class, and we've seen this playbook before. Even Bitwise CEO Matt Hougan flat out said the halving cycle theory is dead because it is literally becoming half as important. Hougan points out to the interest rate cycle as the real driver now. He also said that given the ongoing regulatory process and the early stage of institutional adoption, Bitcoin likely has more upside in this cycle than historical trends suggest. Now, another naysayer to the 4-year cycle is me. No, it's CryptoQuant CEO Ki-Young Ju. His reason, because the old blueprint of whales scooping up BTC early and dumping to retail later on really no longer holds true. In a market now dominated by institutional money, big money investors, the CryptoQuant CEO says old whales are selling to new long-term whales. It's going from whale hands to whale hands, not whale hands to retail hands to be panic dumped in the middle of the bear market. It's shifted the structure of the market entirely. Now, before we get into the next part of this story, a quick shout out to today's sponsor, TANGEM Wallets. Check that bad boy out. TANGEM isn't just another wallet. It's the one-stop shop, all in one vault for your crypto. A sleek card or ring. They have a ring to it, which is pretty cool. No wires, no charging, no app dependency. It works even in extreme conditions. You stay private, you stay secure, no hacks, no seed phrase leaks, no BS, just you in full control of your coins, and with support for 80 plus networks and DeFi tools even built in. It's everything you need. And they're super affordable. Tap the link now for 10% off of your TANGEM wallet. Right down here's the link, and it gets even more affordable. Go check it out. Thank you very much for supporting our sponsors. So back to this conversation. Where do we look for clues here? One option is the traditional market, but unlike Bitcoin's 4-year schedule, stock market bull schedules are all over the place. According to Centerpoint Securities, there have been 14 bull markets since 1932, with an average length around 3.8 years. The longest, a massive 11-year run from 2009 to 2020, which only ended when the world literally shut down. Okay? Meanwhile, the guys over at the Carson Group put the average bull market length at around 67 months. So that's about 5.5 years. And the current one we're in for the stocks, still young. It's just 31 months old, so half the average age of a bull market. Many economists agree it is 5 to 5 years on average for bull markets. So that would say we have another 2.5 years to go. Assuming the Fed doesn't accidentally light something on fire or the world doesn't end, then we should have a lot more room left in the current bull run, and this AI bubble is forming up. With that said, if we go with what Carson is saying, then we still have a lot of runway, and the bull run might not end until like Q4 2027 or Q1 2028. That would break everyone's effing minds in this market. But what if we're still not looking at the real driver? Because behind every bull run is one key ingredient. Money, baby. Liquidity. Oh, liquidity. We got some liquidity right here. Liquidity. Anyway, one of the best ways to track that liquidity, the M2 money supply. You're probably familiar with it since it's been discussed to infinity on YouTube and crypto Twitter. You've probably heard me talk about it once or twice before, but let's look at it from a fresh perspective through the lens of hard money versus soft money, a concept discussed by Fidelity's macro director, Jurian Timmer. In simple terms, hard money holds its value because it's scarce, like gold or like Bitcoin. Soft money, on the other hand, loses value over time because it can be printed freely, like the US dollar, the euro, the yen, or any other paper BS money. Timmers argues that the softer the monetary environment becomes, the more investors start reaching for hard assets. And what makes money soft? And a couple of glasses of whiskey. Okay, that's a different story. Anyway, it's expanding the money supply, okay? That's where M2 comes in. When central banks go on a money printing spree, M2 spikes. Liquidity floods into the system. It's, again, the rising tide that lifts all boats within risk assets. This is all historically very bullish for risk assets as the current environment that we're in right now, which brings us to another question. When will the M2 uptrend end? Truth is, nobody knows, and it won't really end. It'll just have pullbacks and then go up more. It's kind of how it works. They print money to infinity, but there'll be times when they pull back on the money printing. Central banks won't stop their money printing addiction, but Real Vision CEO and global liquidity model pioneer Raoul Pal offers a clue. He believes this cycle could extend well into 2026, and that timing lines up with two big events: the end of the Jerome Powell era at the Fed and the possibility of Trump getting his wish for 1% interest rates. Now, Lark, that all sounds bullish, a 1% interest rate. Surely that cheap money will drive everything to the absolute effing moon. It's going to be great for businesses, it's going to be great for dog coins, and possibly a one-way moonshot. Maybe. Very much possible. But hold on a second. While low rates can indeed juice the market, they also risk overheating the economy and overheating the market, making a top more likely in that scenario, because that could mean inflation comes back, and if inflation runs too hot, the Fed will have no choice but to slam on the damn brakes, no matter who is in charge of the Fed. And we all know what happens then, which will bring us, bad shit, by the way, which brings us to a curious little chart created by an Idaho farmer over 150 years ago. Believe it or not, it points to 2026 as the year of good times, a peak period for the cycle and potentially smart time to lock in profits. That lines up with Raoul Pal's forecast, the idea that Powell could be replaced with someone much more ready to go full dove on rates, someone like Scott Bessent, who will lower rates to 1% very aggressively, that might keep the party going a bit longer. But at some point, the fat lady comes home, the cows stop singing, and it's all over, okay? So when do we sell? Well, first and foremost, again, no one has a crystal ball. But more importantly, maybe we're asking the wrong question. It's not just when to sell, it's what are you holding and what is your conviction? You see, if you've got Michael Saylor's mindset and you're holding Bitcoin for the long term, for the next 10 years, or like him, he's going to literally take it to his grave, then the answer is simple. You don't sell. You just buy more. I think the right mindset is this, though. If you're deep in profit, maybe it's time to take a little bit of money off the table, especially if you have life-changing money. Okay, something that's really going to make your quality of life better for yourself, your family, your parents. Take the freedom, man. Enjoy life a bit. Instead of trying to time the exact top, consider just reverse dollar cost averaging out. The more your assets go up, the more money you take out. Okay, there's still buying opportunities for a lot of stuff, but just mindset shift, right? Take small chunks out on the way up and then walk away and come back when everyone's screaming that it's all going to zero again and start dollar cost averaging back in. That strategy is pretty simple and it works, okay? Don't have to overcomplicate things. Plenty of smart investors in previous cycles made shit tons of money doing that. Maybe, just maybe, that's a decent strategy moving forward. Either way you want to do it, make sure you're locking in gains because nothing lasts forever. Maybe this one lasts a lot longer than people think. But we're coming up to the period now in October, November of this year when we're either going to say, will the 4-year cycle be proven right again? Or is it over and we're going to actually go way longer, way higher than everyone thinks? But even in that scenario, still take money off the table and pay yourself. Thanks for watching.